The market goes down from this high all the way down to here, okay, and creates that low. As soon as we start seeing it bounce up, you need 4 candles. Remember, it's the same thing we just saw on the equilibrium to discount teaching. Once you see a swing low form, you're watching that 4th candle to show willingness to go higher. It does. But then you simply wait. Here's the equilibrium price point, this 50% level in the fib. Price goes through that, so now you're going to be watching it. You want to watch to see if price gets to 62 to 79% retracement levels. It does. And it does it while it's running out that high here. So 2 scenarios. One, you could have used this high down to this low and got a stop out in the initial 62 to 79% retracement levels where we saw earlier, but it ran right through it. If you had not anchored your fib to this high to this low, you would never see this optimal trade entry, okay, or return to a premium to go short. Price is above the equilibrium price point, and it takes out an old high. So we're running stops at an old high, and we're going back into what would be a premium market. We're above the equilibrium price point of the range high and the range low, and we take stops out. That's really, really good in terms of probabilities. And the market goes down and sweeps out a previous low. Remember, when we were looking at the equilibrium to discount, every time we were buying, we were taking profits at above an old high. Okay, so when you see that, all we're seeing is the reverse of that in the equilibrium versus premium market. So we're always looking to sell at a premium. Premium is defined by, it has to be above the equilibrium price point, or 50% level of the Fibonacci, anchored on a swing of clear, discernible price action. In other words, if it looks sloppy, if it doesn't really look like a solid price swing, and obvious price swings are the ones we look at. We're not looking at anything that looks questionable. If it's a pure price swing, we measure it. And this is a high, this is a low, and we went through all the potential stages of all these high to low, high to low, high to low scenarios. Really nice scenario here. Again, taking profits initially at below this low here when it would hit that, and then you'd hold out for a potential run for some of your trade to be taken off below this low here. Now, the market goes into another area of premium relative to equilibrium. We'll go back to this larger price swing here. This low all the way up to this high. The market goes right into the 79% retracement level. Hits it perfectly to the pit, then rolls down. Where do you take your profits at? You're going to be looking to take profits at below this low here, okay, and into the order block down in here, which is what you see right there, okay. You have another range that you can use, this high to this low. Okay. Now, what's really nice about this is if the market's in a consolidation, this type of trading is your go-to. Okay, a long protractionary state in the marketplace where it goes up and down, no real movement higher in one direction or lower in one direction. It just stays in a large consolidation. You want to be trading turtle soups or understanding where premium and discount are. And if you have the high here and you pull it down to the low here, when the market gets above the equilibrium right in here, it goes right into the 70.5 or what would be the optimal trade entry sweet spot, okay, or OTE. And the market is a sell-off there. Where do you look to take your profits at? Below an old low or below this low right there. Every time the market makes a swing low, you have to take a look, and it only takes 3 candles. This is why I do not use the Williams fractal that requires 5 candles. I only need 3 candles. So we have a candle